Let's bring in Michael Schumacher. He's global head of rate strategy at Wells Fargo Securities, and Mariann Montagne is portfolio manager at Gradient Investments. So, Michael, especially the way that bond yields have acted lately, we're still down in the 1.5% kind of range in the U.S. There's a lot of jitters out there. Does that mean we've priced in the reality that there's probably not going to be any major trade breakthrough with China coming?
Probably getting close, Kelly, and I think you hit the nail on the head with jitters. That's what it means for markets. It means volatility, whether it's China, whether it's Iran, whether it's Turkey, impeachment, Brexit, you name it. This is just a laundry list of stuff, frankly, that for investors is very difficult to assess. And listening to the prior guests saying, well, probably not a big deal yet, maybe next year, doesn't bode too well. So I would say volatility seems like it's here. What
happens, Mariann, if the big trade deal never comes? I do think people are saying, well, and this even is a tweet coming from the Chinese side, from Hu Xijin of the Global Times, saying it's going to be these ongoing trade talks, but no real trade deal. And what if that's the status quo for years to come?
Well, I guess we just probably continue as we are today. I mean, we're pricing in no trade deal. You know, when they said that they're going to go from possibilities in these next trade talks to quick exit, the market today is pricing in no trade deal and not anytime soon. So I think we just continue operating in the same way that we're doing today.
Do you change any of your specific investments, knowing that that deal might be less likely now?
No, I think we've got, our focus on going into the fourth quarter, some retailers that, would get help if there was a trade agreement, but we're not factoring that into our earnings estimates at this point. And we're really focused on the U.S. consumer, particularly the low end of the, income period. It's a very large low end of the income pyramid that is getting the majority of the wage gains, and they have a higher propensity to consume. Mm-hmm. And so there's going to be greater purchases at that low end, and that's why we like Dollar General and Five Below here.
Okay, Michael, meanwhile, we're going to hear from Fed Chair Jay Powell in about an hour and a half. What is your expectation now for more rate cuts? And if we're less likely to get some big trade deal, does that mean we're more likely to keep getting lower interest rates?
Yeah, we've got one more rate cut this year, Kelly, and also one next year. But for the Fed, it's new territory. And you go back to Powell's comments at Jackson Hole, he said there's really no precedent for the current situation. Think about that comment. This is the chairman of the Federal Reserve, no precedent.
Is he referring directly to the trade issues?
He was, that's right.
Problems?
Yeah, so I suspect the situation in his eyes probably has gotten a bit worse, a bit more challenging. So we look at that and say, gee, it's awfully tough for investors, it's tough for traders, it's also tough for policymakers.
But let me ask you something. Does it make sense, especially if this is a longer-term conflict now between the U.S. and China, where the tariffs are likely to stay in place for some time? Does it make sense for the Federal Reserve to be cutting rates in response to that when it does? It slowed the economy a little, but the consumer is still very strong. Housing has been a little bit on the uptick lately. I mean, is this the right policy response to what may be a long-term breakup here?
It's a great question. The Fed's been talking about taking out insurance cuts. So the Fed consistently has said, whether it's Powell or the other leaders, that the base case for the economy is pretty good, and it's worried about these cross currents. So trade is probably cross current number one. It is in our eyes anyway. So the Fed, in our belief, gets probably a little bit more motivated to cut, frankly, given some of the disruption over the last few days. But is that enough to push it toward two cuts this year? Frankly, we doubt it.
Right. And, granted, there was some soft inflation data this morning,
right.
Maybe kind of feeds into that. Mariann, do you think rate cuts make sense here?
I think we have two choices. We could just get this October 1 and be done, or we could fall into, a widening decline in growth overseas and be in for a number of rate cuts next year. I don't think we can tell at this point, and I'm going to favor the one and done right in here.
All right. Thank you both.